The overall market continues to struggle with a recovery this year. The S&P down about 2%, but consumers are still spending money to go out and eat. The S&P Restaurant Index is up more than 25% this year. For a closer look at the outlook for the restaurant industry, let's bring in Stephen Anderson, restaurant analyst at Miller Tabak. Stephen, welcome to Bottom Line. Thanks so much for coming on.
Thank you for having me on.
Always interesting when we start talking about discretionary income. We see the restaurant stocks, they're continuing to underperform the U.S. market. What does this mean for big restaurant names?
Well, when we take a look at the overall restaurant sector, as you said, people are still spending. And the bottom line is that the National Restaurant Association expects overall restaurant spending to be up 3% in 2012. However, even with the average unit count down about 2% in the past year, that means that the traffic is going not to the independents or even the smaller chains, but they're going to the larger, in most cases, national chains.
How's the lack of discretionary spending affecting patronage at these restaurants? Can we see a correlation between the decline in jobless claims and the outlook for restaurants, say, over the next 6 months?
Well, certainly. The thing we track is the National Restaurant Association puts out an expectations index, and there is a positive correlation between that and the weekly jobless claims, at least on a 4-week moving average basis.
The independent restaurants, they don't have supply chains. What's their outlook?
Well, I think it's going to be rough sledding for them for a while, and even for some of the regional chains that don't have the economies of scale to get supply chains together and to mount national advertising campaigns.
What's the criteria you use when you're looking at a restaurant's viability?
Well, we use a five-screen criteria to look at restaurants. First, we look at sustained positive same-restaurant sales, market share gains, the ability to raise menu prices without losing traffic, operational improvements, that means things to improve the bottom line, and balance sheet and cash flow improvements.
How do you, because the one thing that stuck out for me was the ability to raise those prices. How do you do that in an economy where people are still seriously watching every dollar?
Well, I think the key is having a relevant concept that speaks to everyday value is really what counts. And that's why some chains have been able to raise prices successfully while others haven't been able to do so.
What are some of the names you like?
Well, the names we like right now, we like Brinker Restaurants. They are the parent company of Chili's. It's 86% of total sales.
Yeah.
And the thing we're looking at there is that Chili's has mounted a turnaround story that's built on same restaurant sales expansion, renovation of existing units, and reducing costs at the restaurant level. So those three things will give Brinker a powerful rebound in earnings over the next several years.
You also like Darden too, right?
We like Darden. I think a lot of the investment community has soured on the name, particularly as Olive Garden, which contributes about 45% of total sales, has lost its groove in recent quarters. However, Olive Garden has been regarded for the past decade as a value-driven concept, and we think a turnaround there will be within the template of existing value-based concept. And I think it'll be easier time for them to turn around than it was for Red Lobster, which took years to turn around and finally is showing fruit.
Stephen, could I ask you quickly, which restaurants are having problems right now?
Well, I think, as I mentioned, I think the smaller and regional chains are having difficulties. I think some of the smaller bar and grill chains in particular, names like Ruby Tuesday and O'Charlie's, don't have the national grasp that some of the larger companies like Chili's or Applebee's or TGI Fridays do.
We're going to see a big rebound next year?
I think it's going to be a slow but steady recovery, and I think, again, to the larger restaurant chains and to the ones that have the ability to raise prices and make additional marginal improvements, they'll be the ones that do well next year.
Stephen Anderson, restaurant analyst at Miller Tabak, joining us on set. Pleasure to meet you. Thanks so much for coming.
Thank you very much.
Thank you.